Okay, so this is Stephen Ballard. Okay, so he's from RCN. So what does RCN stand for?
So it actually doesn't stand for anything.
Oh, really?
Which is always an interesting talking point. We started in a different industry and we kind of adjusted from there. Really, our owner wanted to buy a bunch of properties himself and couldn't find anyone to leverage that money like during the recession. And so he basically said, you know what, we're going to do it ourselves. And so 2010, we started trying to lend out to investors and made a whole bunch of mistakes, and it just kind of built our way up from there, right?
Okay, so you guys have been in business since 2010?
Yep.
Okay, good. A lot of companies here have been in business for a relatively short time. Okay,
Yeah,
that's
so
interesting.
You'll notice in our industry, which is specifically real estate investment property financing,
Right.
you're going to notice a lot of people were founded after the recession in 2007, 2009, that rough range, right? The reason for that is because most banks prior to the recession would lend on rental properties, would lend on fix and flip, which was less common, but they would do it sometimes. Now, interest rates, programs weren't custom for that, but they would do it.
Yes.
So you'd go to your local bank and you could get a loan on a rental property, right? After the recession, the bank said, I don't want to do that because it's not backed by the government.
Yes.
So if you're working with an owner-occupied home, the government has more invested in that because they want to make sure that the citizens are homeless.
Yes, right.
Which makes sense.
Yes.
On investment properties, the government says, I'm not really worried whether a landlord loses his seventh rental property.
Right. Yeah.
Right?
Yes.
And so with that, coming out of the recession, the banks couldn't get a guarantee from the government on these loans, and so they said, we don't want to do loans that they perceive as risky, right? And so you'll notice, like, we were founded in 2010, Most of our competitors were in that range in 2010, 2011, 12, 13, maybe into 15 or so.
Right.
And that's really where most of the industry is coming. There's only a couple people that were prior to that, and most of them were really small. So worked in a city, a small region, right? And that's it.
Okay, the banks will know where they get their money from. So for people like you and your competitors, where does the money come from?
So the answer is going to be it depends. Some of our competitors are owned by large financial institutions.
Okay.
Some are backed by those institutions.
Okay.
Some will do some level of like crowdsourcing, for example.
Okay.
Or at least that was the goal at the beginning, and they do some degree of that. A lot of our own capital is from our owner. He has another business, and he takes his money and reinvests it in what we do.
And then it grew that way.
Yep.
Okay.
And then every company, RCN included, has financial backers. So we'll turn around, a lot of these loans are then sold on the secondary market.
Okay.
So for example, a 30-year fixed interest loan, we don't want to hold that forever.
Right.
No lender does.
Of course.
Right? I don't know a single lender in our industry who holds those loans.
It's too small.
And so those tend to be packaged together and then sold off to large institutional investors.
Right. Okay, cool. Now let's talk about your programs. Okay, I know you have a fix and flip program there. You have short-term rental program. You have long-term rental program. I see your rates are very good for fix and flip, and it's like 12 to 18 months and stuff like that. Let's talk a little bit about that. What will be your LTV? So are you typical like some of these guys will give you 90% of the purchase price and 100% of rehab? Do you guys do the same thing?
Yeah, so there's 4 really major programs. You're going to see fix and flip, which can be 1 to 4 family or 5+ unit. Right. You're going to see ground up construction, which is becoming more popular, especially in the last couple of years. People are, especially investors, are struggling to find properties to invest in.
Right.
So they're competing with end buyers and homeowners.
Right.
And now it's a little bit tougher, so you're starting to see more people transition towards ground up construction.
Okay.
We see a lot of both single family, so 1 to 4 family, and multifamily long-term loans. So typically 30-year, and those are kind of the 4 different programs.
Okay.
On the fix and flip, you do tend to see 90% of purchase is what RCN is going to cover.
Okay.
You're going to see 100% of the renovation costs will cover.
Okay.
Generally, total loan capped at no more than 75% of the ARV, the after repair value.
Okay.
So, for example, the client's going to buy something for $200,000.
Okay.
They want to put $100,000.
Not in the Bay Area, though. Not in the Bay Area.
Well, all right, Bay Area out of 0. How about that? So let's make the numbers easy then. You're going to buy it for
$1 million. That's what I was going to say. Yeah. Okay.
They're going to put $200,000 into it.
Okay.
And then after that, the expected property is going to be worth 1.6. Just to make the numbers easy for me to do in my head.
Right. Exactly.
So on that, typically, if they have experience, we're going to lend $900,000 towards the purchase price.
Okay.
So they'd have to bring $100,000 to close.
Okay.
Then we'll have the money set aside, $200,000
Right.
for the construction,
Right.
for the renovation, and they'll be able to continuously draw against that, which is a reimbursement
That's
process.
good. I know
right?
that. Yes.
And then that total loan comes out to 1.1 million.
Yes.
Right. With that, we're comfortable because 75% of that ARV
Yes.
would be 1.2.
Right. Exactly.
Because you got that 1.6 million ARV.
Right.
We're under that 1.2 threshold.
Right.
And so that means we think the borrower is going to make a really solid profit margin, so
Right.
we're comfortable.
Okay.
If a client needs us to go above that 75%
Okay.
ARV,
Okay.
it means that their profit margin is really
Yes.
slim.
Okay.
And that's what we're concerned about. And so that's why we'll say no.
Okay.
Because we're going to say, hey, it doesn't really make sense for you
Okay.
to do this deal because you're not turning the profit you think you're going
So
to.
what if somebody, okay, so that's for a savvy investor, okay, somebody been doing it for some time. But how about for newbies? Somebody's new. What would be the same thing? 90%? You fund?
Typically, newer investors, you're going to see 80% of purchase.
Okay.
Sometimes you can see 90. It does partially depend on profit
Okay.
margin, for example, credit score, the local area that they're
Okay.
operating in. So if you have an area where there's much higher appreciation,
Okay. Okay.
so if you're seeing 5-10% growth in home price appreciation,
Like
we're
in the
gonna
Bay
be
Area?
more-
Yeah.
yeah, we're going to be more comfortable going higher LTVs. Right?
Okay.
If you have an area that has negative, so if they dropped
Yes.
1%, 5%,
Right.
in home prices, obviously we're going to be even more.
Let me ask you another question, a follow-up question to that. So let's say that person has no experience. They want to become a flipper, but they can piggyback on somebody who has a lot of experience. Would you add that person on the deal?
Yeah.
Okay.
Yeah. So because most of our deals, or virtually all of our deals, are done through an LLC, an
Okay.
S corporation,
Okay.
a trust,
Okay.
something along those lines, right?
Okay.
Some kind of business entity.
Yes. Yes.
With that, you can have multiple people in an
Okay.
LLC with no issues.
Okay.
Right? You and I can go and buy a rental property together, for example.
Right.
And if I have a 600 credit score and you have a 750 credit
Yes.
score, and we're
Okay.
equal partners,
Okay.
we're going to assume that you're part of the financial decisions.
Right.
You've got great credit, so you're making good financial decisions.
Okay.
So it's probably going to be fine for the entire
Okay.
project. So we'll take the higher FICO score of the
And you fund on the higher FICO score.
we'll always use the higher one.
Good. And the next thing is basically for rental properties. Let's talk a little bit about rental properties. Okay, short-term rentals. I mean, what do you mean by short-term rentals? Is this for Airbnb or what? What is it?
So for short-term rentals, we can do, really it can be taken either two ways. We
Yes.
can do like an Airbnb, a vacation home, something like along those lines.
Right.
It has to be a rental. So it can't be something where they stay in it, 1 week
Yes.
themselves and then rent it out the rest of the year. It has
Okay.
to always be rental.
Okay.
But if they're owning Airbnbs, one, multiple, whatever,
Yes.
they can go through and we can do purchases of those. You can do refinances of those, kind of whatever you need to do.
Yes.
And we can count the Airbnb income rather than what would typically be a long-term market rent rate, right?
Okay.
We can also do the case where some people will do, which is they get a property.
Right.
Say you're going to buy a property that's had management issues.
Okay.
So the rents haven't been there. It's had a lot of vacancies.
Okay.
Some investors will come in, they'll buy those, they'll get them to perform well, and
Right.
then they'll turn around and sell them to other investors.
Right. Okay.
Because now they can say, hey, when I first bought this property, it was losing money on a monthly basis.
Mm-hmm.
I invested, $50,000, $100,000 into it to get it cash
Right.
flowing again. I'm going to sell it for, $200,000, $300,000 after what I bought
Right,
it. Now that
right.
it has a higher cap rate, all that kind of stuff.
Okay.
So you can do either one.
Okay.
So both are really kind of compiled into that.
Okay. So let's go to the last one here, the long term. So long term is like permanent rental. Okay. And your rates start at 3.49.
Yep.
And can you buy those rates down?
Yeah. So on a 1 to 4 family property, you're going to see fixed interest,
Mm-hmm.
fully amortized, 30-year term. Generally, I'm seeing interest rates between 3.5 and 5.5, give or
Right.
take.
Yes.
You are going to see if the client wants to pay fewer points, so say 0 points, for example.
Right.
Which is something we do very consistently.
Right.
You're going to see an interest rate, 5.5, 6%, something along those lines.
Okay.
Right? Maybe low fives, but somewhere in that range. And if they want to, we'll give them the option to say, hey, we'll do this loan at 0 points and 5.5% interest.
Right. Okay.
Or you can do it at, say, 2 points and 4.5% interest.
Yes.
Or you can do it at 4 points and 3.5% interest.
Okay.
So we give all of those options to brokers or agents, and
Right.
then obviously they can turn around and give that to their clients.
Okay. Good. And so let's talk about your turnaround times with fix and flips. Okay, how long does it take for you to fund that deal?
Yeah, so most of our deals on 1 to 4 family homes
Yes.
are about 3 to 4 weeks total.
Okay.
So most of that's appraisal time. Right?
Yes.
Everyone knows
Okay,
appraisals
okay.
are not moving fast.
Okay.
Right. On on multifamily properties.
Yes.
So 5+ unit, 20 unit, 30 unit, whatever
Yes.
it is. Generally, we're seeing about 4 to 6 weeks on those.
Okay.
Again, a large chunk of that's just appraisal time. Commercial narrative appraisals are taking longer than your average 1 to 4, 1007 kind of thing.
So rental properties. Okay, I know you say fix and flips. It will be like 2 to 4 weeks, right?
Yep.
Okay, and how about rental properties? Is that the same time frame?
Yep.
Okay, that's
Yeah.
cool.
We typically don't see a turn time difference between rentals and fix and flips.
Okay.
We do see a difference between property size.
Okay.
So a 20 unit will take longer.
Right.
To
That's
close
a
than
commercial
single
property,
family.
yes?
Yeah, exactly.
Okay. And they, typically they cost more. The appraisals
Yeah.
cost more.
Yeah, the commercial narrative appraisals are going to be more expensive.
Right. Do you fund land or you
We do
don't?
not.
Okay, do you
lend
fund?
on- We will only lend on raw land if it is going to be developed into a residential property. So 1 to 4 family or
Yes.
an apartment building.
Somebody has a piece of land and it's fully entitled.
Yep.
So you guys are funding that.
Yep.
We're funding construction.
As long as they're constructing on it, yeah.
Right,
If they
right.
want to have us lend on land, just have the land stay barren, then that's not something.
Okay, so they have a
It
piece
has
of
to be a
land,
development loan,
a
basically.
development loan. So they have a piece of land, maybe owned free and clear,
Yep.
and they intend to build a multi-family over there.
That'd
What
be fine.
are you going to fund? You're going to fund
So-
on the land and the entitlement and the construction, or what are you going to fund?
So a lot of times we see people already own the land, like you said.
Yes.
A lot of times we'll see permits, plans, entitlements in place,
Right.
which is ideal to see
Right.
all of that in place.
Ideal, yes.
Because it means that it can take a while to
Right.
get plans and permits approved and
Right.
all that kind of stuff.
Right.
So ideally, a lot of people already have that stuff laid out and approved.
Right.
Then you're looking at a case where sometimes we can
Right.
lend towards the initial advance. It does kind of depend.
Initial
on
advance.
So,
What do you mean?
So sometimes we can lend on the value of the raw land
Okay,
itself,
okay.
and then also construction costs.
Okay.
Sometimes it's only construction costs, and it really does depend. It's very deal specific
Okay.
because it's just a leverage game. Right?
Okay.
So a lot of times you're seeing 80 to 90% loan to cost.
Yes.
Loan to cost is just a common metric you're going to
Exactly.
see with ground up construction,
Right.
relative to existing properties, for
Yes.
example.
Right.
And with that, generally you're going to be in that range, 75 at the low end,
Yes.
90 at the high end for loan to cost.
Yes.
And as long as that includes the construction budget,
Right.
we can take a look at lending towards the current value of the property.
Would you fund the soft cost?
We can work with soft costs and hard costs, yeah.
You can?
Yep.
Okay, interesting. Maybe talk to me about a little bit about that. So somebody has a piece of land, and this is actual things, actual deals that I'm working on right now. Okay, so basically, they have a piece of land, and right now it's generating some income, right? But it's not just land actually, but they can build 40 units there. And would you fund an entitlement? So maybe the entitlement is going to cost $300,000. By the time it's done, it's going to be worth like $3 million. Right now, they just bought it for about $1.2 million. Is that something that you will look into case by case?
Case by case, yes.
Right, okay.
And a lot of that does depend on how experienced the investor is,
Right.
what their plans look like, what their profit margin
Okay.
looks like, kind of what we're going to expect, how far along they are.
Okay.
For example, have they started the process of permits and entitlements and they're waiting for it to finish?
Right.
Or have they not even started it?
Okay.
How long does that process take in that market? Is
Okay.
it, a 2-week process
Yes.
where the town is really easy to work with?
Right.
Or is it what we've dealt with for a lot of the last year
Yes,
and a half,
okay.
which is local title offices, local courts and stuff like that.
Right.
Remarkably difficult to deal
Right,
with because
right.
they've been understaffed, they've
Right,
been trying
right.
to work remote.
Or they're
So a
lazy.
lot of- and so a lot of that process is taking longer.
Right.
So if you're in an area where permitting and entitling and that process can
Right.
take 6 months,
Right.
it's worrying to me to not have that even started.
Okay,
Right?
okay.
But if it's finishing up, that's
Right.
something we can kind of work around. So it is very case
Okay.
by case.
Well, thank you so much for your time, Stephen. I really appreciate that. I'm going to bring you some loans.
Sounds good?
All right, man. Thank you. I appreciate
Absolutely.
it.
Paul,
Okay.
if you have any other questions, you let me know.
Yeah, sure.